Hi, everyone. This is Dale Pinkert at TradeGateHub.com, and I have the pleasure of being joined by Joseph Wang. A lot of you people probably are aware of Joseph. You can follow him on Twitter at FedGuy12. Joseph, thanks so much for taking time out of a pretty volatile day to be with us and talk about what you're bringing to the public. You're bringing what was really kind of in cloaked like the Wizard of Oz, what happens at the Fed, and appreciate you giving it more transparency in the public arena. Great to have you.
Thanks, Dale. It's a pleasure to be here.
Okay, so before we get to the markets and things like turbo tightening, and I do want to cover these subjects. What was going on? You were an undergrad student, and you said, I think I'll practice law. Is that the thought process you had as an undergrad? And was that something that you felt inside that you wanted to do, or did your mom and dad want you to be a lawyer?
No, they didn't. I think as an undergrad, what I was thinking was I wanted to have a career that paid me a lot of money and that was
Okay.
fancy. And so back then, I thought that was law. But what I didn't realize was that you actually have to practice law. So, you end up sitting in a fancy office and making a good salary, but you actually have to do the work of being a lawyer. And in practice, that really just means being a fancy secretary and doing paperwork. Uh,
Okay.
and it was really boring to me, and it's not what I wanted to do.
Okay. Let me ask you this. Were you at any age prior involved in trading for yourself or financial markets? What lit the interest on economics and the mechanics of institutions like the Federal Reserve? What
So
was it?
I graduated in 2008, and that at that time, as you all remember, that was during the great
Yeah.
financial crises, and all you could
It
ever
wasn't
read
so
about.
great for me, was it for you?
Uh, it was not great for me. Obviously, when you graduate in 2008, that's just the worst
Yeah.
time to
Oh,
graduate.
yeah. Very good timing there, Joseph. Um, okay, so we were in 2008, and you're going to say, were you trading?
Yeah, so I had my own small account, just trying to playing around with the markets. And what I realized first was just how little I understood of what was going on. And I think at the time, very few people, even in the professional commentary yet, understood what was happening too. You had the markets gyrating just hundreds of points every day in the Dow when that was actually a big number. You had the Fed doing all sorts of new things like quantitative easing, like these emergency liquidity facilities that no one really knew what was happening either. And you had what was really a global crisis happening in the Eurozone as well. So that was super interesting to me. And I really wanted to understand how everything worked. And that's really what got me down into the rabbit hole of understanding just what the monetary system is, how financial markets work. And that's kind of a passion that I've had ever since. To me, I
Okay.
think of it as a big puzzle that's
Uh,
continually changing and that you're always trying to solve.
I love that. So we really don't have to do brain exercises once you have the color hair I have, because trying to figure out the market correlations and directionality, etc., is a great mental exercise. I wanted to ask you. Um, I was going to ask you. It's probably pretty difficult. You can't just say, you know what, I want to work at the Fed, and I was going to ask you how you were able to get hired there until I noticed you went to Oxford for your for a degree in economics.
Yeah,
Um,
so I actually practiced law for a few years, but I really wanted to work in the financial services in the market-facing role. But as you recall, that was in the years after the GFC, there just wasn't a lot of opportunity there. It was kind of a sector in distress. So I
yes.
figured that the easiest way to make this transition would be to just go back to school. And so I went back to school. I came out. I started working out as a credit analyst for a few years. And at that time, we were doing a lot of, so I was in securitized products. And in the consumer side, and we were doing a lot of deals when one day the deals dried up, and I was thinking that, that's probably not a good sign. So I needed to do something else. One of the jobs openings that I looked at was a job posting on the open markets desk at the New York Fed. And strangely, I applied and I got an interview and they took me. And in my experience, that usually doesn't happen because usually someone and they get you the job. But in this case, I just really just applied to the website,
Wow.
uh, did some interviews, and I joined.
Yeah, so some synchronicity going on there. So it was meant to be. You didn't have to force it. It was meant to be. So tell us what your first few days or weeks or months at the Fed were like for you, and what were your duties?
Well, first of all, it was very exciting to me at the time. I mean, I got my own Bloomberg, and I was at the Fed where so much mysterious things were happening that people outside were always curious about, but never knew. My first few weeks on the desk were actually pretty boring. So the thing about the Fed is it's a public, it's the public sector. Everything is slow. So when I arrived, they actually did not even have a computer for me, and they did not have any access for me. And they were like, "Yeah, this is slow. We'll get you access, but it might take a couple weeks." So what they did was they gave me a book called Sigm's Money Markets. It's basically the gold standard in money markets. And since money markets is basically the Fed's core job, right, controlling short-term interest rates, they thought that was very important. So I was sitting at that desk with this big book, the size of a dictionary in front of me called Sigmund's Money Markets, and told to read that. And everyone basically ignored me for the first 2 weeks while I sat there. And, I'm the new guy. I'm just reading
Yeah,
there.
right.
But as it happened, I really like this stuff. And, everyone is good at different things. To be perfectly honest, I was not very good at law and I would never have been a good lawyer, but I was pretty good at, just trying to understand how the system worked. I was very curious. And at the Fed on the open markets desk, you have tremendous learning resources. If you want to learn, you can really develop some expertise there. For example, you have access to tremendous amounts of confidential data. You get to see the regulatory filings of like big banks. You get to see reserve accounts. You get to see transactional data in markets like, let's say, uh, repo or commercial paper. And you get to talk to people all over the financial system. So when I was on the desk, we could, call up a foreign central bank, ask them what they think. We could call up large investment funds, we could talk to dealers, we could talk to banks. So it was really an opportunity to be behind the curtain, so to speak, or
Yeah.
at one of the centers of the financial world. So it was a way to, I think it's a really good learning opportunity for me.
Yeah, I'm a big believer in community, and it sounds like you guys had one. And talk about being inside to be able to call BOJ or BOE and talk to people and get their views is a little different than the content we get on Twitter, right, Joseph?
Yeah, yeah. To be clear, there's a lot of bad content on Twitter, but there's some really good, really smart people
Yeah,
there too. You
there
just
are.
got to know who to follow.
Yeah. So your last when you were winding down, and you were what, under the Bernanke tenure or the
No,
Yellen?
I was actually no, no. I was at the open markets desk. I left actually a year from around now actually. So I was there quite recently.
Okay.
I was there all through COVID and
Okay.
under the Powell Fed.
Okay. All right. And why leave the Fed to pursue educating the public? Was there any reason? Was this just another extension, or you have other projects in mind, and you felt like um, you had done that cycle for yourself at the Fed? You learned, and you want to share what you learned, because what is the good of anything until it's shared with another?
So at the Fed it's a great place to learn, but it's actually not a very good place to work. So the way the
Okay.
public sector works is that they never fire anyone. So you have just a whole lot of bunch of people sitting around, and you are basically judged by how long you've sat in your seat. And I felt that I learned all there was to learn. There was really no point in being there, and I wanted to be judged by what I could do, just not how long I've sat in my seat. So now I'm out, just kind of running my own thing, teaching people through books, through online courses, through blogs, through
Yeah,
podcasts, and of course, trading my own book, which is always fun.
love trading. So Central Banking 101 is a book that Joseph is talking about. You're missing part of a star here. I'll
Uh,
fill it in. I'll fill
uh,
it in with a little yellow dry mark, buddy. All right. So, now I want to get to the meat of things. And, when you broke onto the scene, one of the things that you started making very popular was the Great Steepening. And, I understand what it means. It's about the yield curve and the yield curve steepening because of, the Fed has more control of short-term rates than they do long-term paper. Those are more like the bond vigilantes, right?
yeah,
Did you ever meet a bond vigilante? Did they wear a mask?
I think they only exist in fairy tales.
Is a plunge protection team a fairy tale? I don't, is it?
Yeah, that's what we do. But no, we don't buy
Oh,
equities.
all right. All right. So getting back to the great steepening, and you could go back and really the long end of the bond market. I'm using TLT as a proxy here, Joseph. And I wouldn't be short the long end or the short end here. Think that we're getting set up for what could be a pretty good short squeeze. Why are people? And do you think there's potential of a bond rally, maybe 10-20% rally in bonds back to the breakdown? And what effect does that have on the narrative of the great steepening? Will the steepening correct if there is a bond market rally? What's your take on what's
I,
set up since the
I,
last
I
Fed?
think I think we've actually had that rally right now. I think
It's over.
if you look at the 10-year, I mean we hit I think 3.45%, and then we're
Yeah,
back down to almost 3.
right.
So
And you
so
think we're on our way back up?
I think that's how I view it, and I'll tell you why.
Okay.
Well, first of all, I mean this is a pretty good chart, right? It looks the trend is quite strong upwards.
Yeah, yeah,
So I think of asset prices as basically supply and demand.
yeah,
Um, the thing you want to that you want to keep in mind in bonds is, or any asset, is that people buy for very different reasons, even if you're looking at stocks. Now, if you're looking at stocks, I think the textbook would say things like earnings or P and things like that. But in practice, we can easily see that's not true. Look at things like AMC, or look at
yeah,
things like those other stocks. Uh, why are they going higher? They're going higher because a lot of the people who are buying are the dealers hedging their short options positions. So people
right,
buy for different reasons.
right,
This is doubly true for bonds. In the global financial system, US Treasury bonds play a very special role because they're safe assets, and a lot of people under regulations have to buy them. So you have banks, you have foreign reserve managers, and of course you have like the Fed who was buying it. So you really can't look at this as anything other than supply and demand. And what's happening going forward is that you're going to have tremendous amounts of supply, and I mean tremendous. And
okay.
that's due to QT, and that's due to just the primary deficits that we have.
Who's going to
So
take the other side of QT?
yeah, that's the question, right? So
Yeah,
just to level set here. So we're probably going to have about $1.5 trillion in supply coming out this year, next year, and the year after. Pre-COVID, it was about 500 billion a year. So we're having tremendous amounts of supply at a very high rate for an extended period of time. Now, the marginal buyer of these securities pre-COVID was the hedge funds. It was part of their basis trades. Post-COVID, it was the Fed and it was commercial banks. And if the Fed is out, the commercial banks are also out. So we're going to have to go through a process of price discovery where we find this next new buyer. I think it's going to be volatile, and I think that's part of the reason why that we're probably going to have more downside in price, upside in yield, from my perspective.
okay. So you still feel that the 30-year and the 10-year is mispriced. Looking at the 10-year, do you think we're going to make an advance towards this high was 3.5? This was
No,
320, up towards 4%.
I expect us to be above 4% by the end of the year.
Okay. So then let's get to something that I also saw you write. You know, people are saying they're going to go and tighten and restrict and, turbo tightening until something breaks. And then you were talking about that they may have facilities when something breaks as they're on this course. Being at the Fed, is there a risk of bail-ins in the US?
No, there's no risk of bail-ins. So just to level set with everyone, bail-in is, for example, when a bank, let's say, goes bust. So what that would do is make the depositors take a haircut.
Right.
Right? So, for example, if I had money in, let's say, JPM, and something bad happened to JPM, and they were going under, let's say I had 100,000 there, they would kind of haircut that to make the creditors, well, to contribute to the rescue effort.
Right,
So
because it's not really your money, it's JPM's, right?
it's an IOU from JPM. It's like any
Okay,
other creditor. If you
okay,
lend money to a business and it fails, the creditors sometimes take haircuts.
right.
It's really, really bad policy to do that, because that you destroy confidence in the banking system. So
Makes me
I've
a little nervous, but you say
exactly.
no chance of anything systemic that would lead to that. Why do you say that it couldn't happen here?
So I think what happens is that when you have a crisis, usually there's a reaction to that makes sure that the next crisis is never the one beforehand. In 2008, we had a crisis in the banking system. And at that time, it was basically a run in wide amounts throughout the financial system, but it's centered on the banking system. The authorities looked at that, and they essentially mandated a whole bunch of regulations that quasi-socialize the banking system. So when I look at the US banking system now, I see a system that is just super secure, even boringly so. The easiest
Okay,
way
yeah,
that you can see this is to see what happened in March 2020. March
right,
2020 was an event of tremendous volatility.
yeah,
You had a whole bunch of markets and a whole bunch of actors breaking down, but what did not have any trouble at all was the U.S. banking sector. They just have so much liquidity now. And the quality of their assets are much higher, that there's really no concern from my perspective of any banking distress in the
because
U.S.
we cleaned it up with the Volcker rule, et cetera. But could there be another epicenter that could spread? Like a lot of people concerned about European banks, and people aren't really talking about this much. It would have meant something 10 years ago, but any thoughts on the Russian defaults
Yeah,
that we had?
that seems so. I don't think that's going to be a big deal, because it's something that the market was prepared for. Well, there's actually a couple of reasons. One is that Russia is somewhat closed as a financial system, so there's not a lot of exposure from let's say the U.S. to Russia. People don't really buy Russian bonds or lend to Russian companies in Russia that much from the U.S. And also, as I mentioned, people
The
have been
ruble was one hell of a buy after the invasion, wasn't it?
yeah.
And let me ask you this, Joseph. And I saw it, and my charts were still running, but most of my associates said I couldn't get a ruble trade off at a forex broker. That most of them were not taking orders. Is the ruble trading on the open market, or is it strictly a domestic market?
Yeah, there are
Um,
capital controls there, so it's not freely traded.
okay. All right, good. I don't feel as bad that that I missed that one. Um, it's kind of close, but really, and I've heard you talk about this before, and I'm noticing a little shift. And you wrote about that eventually the BOJ was going to take some type of action. Technically, we're getting some non-confirmations up here at this 137 level. It may not be the top, but it could be a top. You never know if you have the top or the bottom until you look back in the rearview mirror, right?
Yeah, it looks like there's some resistance there around
Yeah,
136.
yeah. So, do you think that? I mean, is this a crisis for the
Uh,
Japanese, and are they going to do anything about it? They don't care. Um, I know some people follow the 40-year JGB because they say it's cleaner. What's your take on what's happening here with
So
the yen?
the Bank of Japan has control over this. They have the tools to make it stop going up if they want to. So when I see this, I think of it as a policy choice that they made. They want to have a weaker yen. Maybe they think that could boost inflation or stimulate their exports. I'm not sure. But this is something like this big move. This is definitely something that the BOJ sanctioned.
Okay.
If they want, they can stop it, and eventually they will stop it. So
Through
markets.
intervention?
So there's two ways this could happen. They could intervene in the forex, so they can start buying yen, selling dollars. That's not really the right way to do this, because it's only a temporary band-aid.
Right.
The right way to do this would be to
It's
just
like releasing oil from the strategic reserve.
yeah, you will run out of
Yeah.
SPR.
Yeah.
So the right way to do this was simply to just readjust yield curve control. So the
Okay.
big driver of this move is that everywhere in the world rates are going higher, other than Japan. So even
Right.
let's say the the 10-year bund is going higher, but the BOJ is keeping the 10-year JGB just kind of pinned out. Okay, it can't go
Yeah.
above 25 basis points. And so the currency is release valve. If it wants to stop the currency from imploding, it needs to make that yield curve control target a bit higher. It could be like
Okay.
50 basis points. So when the BOJ feels that they have depreciated the yen enough, I expect that's what they'll do. And I think that has implications for global rates because the rates are just strongly interconnected globally.
Yeah.
So when you have the BOJ, if you have the JGB move higher, I think that's going to push rates higher throughout the world.
A lot of analysts believe the rate hike from the Swiss National Bank was really a shot across the bow for the rest of the globe. Do you think it was significant?
I think it's interesting
Symbolic?
that the S&P is always likes to surprise the markets. I think a few years ago they surprised with the
Oh
just
gosh,
letting
they
go of the
pulled the
peg.
peg. Yeah,
Yeah, that
they
was.
bankrupted a lot of people.
But
What's with these gnomes? They get up on the wrong side of the bed sometimes, or
yeah,
what?
I guess they feel like surprising the market is a good thing. I mean, it's not what the Fed
Yeah,
does, obviously, but um, yeah. So
uh,
boom.
it's probably from not from living in the snow all the time. But I also wanted to ask you, have you ever seen a time period when China was easing while we were turbo tightening? And what are your thoughts about that being out of sync? And I noticed Chinese assets have been outperforming most other global bourses, holding up better.
Yeah, that this is interesting. One thing that I've heard that I thought made sense is that this is kind of if you're thinking from China's perspective and you're an export-oriented economy, you're competing with Japan, and so Japan is massively depreciating. I think that kind
Right.
of forces you to also have to kind of depreciate a little bit as well,
Okay.
just to stay competitive. So maybe that might be some of that, but
Yeah, the yuan looks pretty constructive. That was a nice breakout with the yen. You're right. It coattailed the yen move, right?
yeah. So it's that might be some of the consideration there.
Does the
Uh,
Fed care about the dollar, Joseph? I mean,
yes,
they always say it's a purview of the Treasury, right? That's not their domain. Do you think, and I know everyone's bullish a dollar right up here. I mean,
yeah.
you can't really find a dollar bear, but would a weaker dollar serve the Fed's interests while they're on a restrictive diet and turbo tightening that a weaker dollar would kind of mask and cushion the turbo tightening? Do you think they want a strong or weak dollar?
I think they want a stronger dollar, and they've told you that. So in Chair Powell's testimony last week, he was asked, "What do you think these rate hikes do?" And he's like, "Yeah." So he gave three things: lower asset prices, slow down interest rate sensitive segments of the economy. And the third he cited was a stronger dollar. And the context was that a stronger dollar helps lower inflation from his perspective. And as they say, don't fight the Fed. Fed wants a stronger dollar. And as you correctly noted, that is the purview of Treasury. It's not really something the Fed should be, messing with. But, if you raise the interest rates mechanically, all things being equal, you do get a stronger currency. So if that's what the Fed wants as part of its toolkit to fight inflation, then I wouldn't fight that.
Would they continue to tighten and turbo tighten if WTI took out $94 and the measured move is down to about 70, between 80 and 60? Would that give them an excuse to pause?
I think they'd have to see it show up in inflation. So what Powell was telling you is that, and so the Fed is very different from the Swiss National Bank. They'll actually tell you straight up what they're going to do. He's not going to wake up one day and be like,
I don't know who to believe anymore, Joseph, but you. Yeah, I'll believe you because you're not, right. You were on the inside and now you're on the outside.
I'll translate what Powell was trying to tell you guys. Okay. So he's saying that I'm going to keep doing this and I'm not going to ease until I see clear and convincing evidence that inflation is getting lower. Now, what does clear and convincing mean? He tells you it's a string of prints of over a few months of lower inflation. So if WTI going to 75 will show up as lower CPI going forward for a number of months, then I think they reverse path. But
isn't there going to be a middle step between tightening and easing called pausing? And don't these actions that the Fed take now really have a lag effect on the economy 6 months down the line, even though we're getting some immediate reaction here?
I think that so if you were a PhD economist, I think you would say, as you just said, monetary policy acts with a long and variable lag.
Yeah, I'm brainwashed.
Powell's actually a bit smarter than that. He'll tell you that this when we do anything in interest rates, it immediately gets priced in. So in one of the channels, the financial assets channel, that will happen immediately. That would immediately impact that. The stuff like housing and more or auto loans, that's probably the long and variable part. So I think the effect would be uneven. You'll feel it quickly in some sectors and slowly in others.
Okay. So continued bear market in stocks, sharply higher yields, commodities as well now joining that parade of being under pressure, strong dollar. Sounds like a bit of a disinflationary environment. Do you think it could turn into a deflationary environment?
So one of the things I think actually is probably the biggest story that I don't hear about a lot is something that was first mentioned by, let's say, Charles Goodhart at the Bank of England, and also Peter Zeihan is a big advocate of it, is that we're going into a world where we have structural shortages of labor. And that's because the boomers are retiring and birth rates have been low. So the working age population, the population between 25 and 65, that is actually going to be decreasing for the, just basically from now on. And that's going to push wages up secularly. And we're seeing this already. A big reason why we have so much, we're help wanted signs and wages going higher right now is during COVID, a lot of boomers retired early, but they were always going to retire anyway. And so if you have wages going up secularly, that's a very big part of costs. And so for me, I think it's hard to see a deflationary world where one of the most important commodities is going to be in structural shortage going forward. And that's not even a talk. Yeah, yes, labor is what I'm saying.
Okay. I was always under the impression a lot of people wrote about, and I thought the demographics were, poor across the world except the Middle East, but I thought the millennials were as large of a group as the baby boomers. So why can't they replace the boomers that are retiring? They don't want to go to work.
Well, one is that Generation Z, which is the generation between millennials and boomers, is relatively small, and the Zoomers are also very small, which is the generation after the millennials. So
Okay.
yeah, so overall, the population is the working age population is shrinking.
Okay. Hard landing, soft landing.
Because I think that a lot of so I actually think we're going to have a soft landing, and I think that because when I look at just the demand side, you know, what drives consumer? I focus on money. Um, where do the consumers have money to continue to consume? Is there going to be persistent demand? Now, consumers get money from one of three places. One is from their job, two is from their financial savings, and three is just borrowed from a bank. As we know, wages are going higher. So for the higher income people, they are losing on an inflation adjusted basis. But for the lower income people, they're actually getting real wage gains. So let's say the people who work in the services sector, they're making more money. Financial wealth, well, the stock market has done a lot, but compared to 2 years ago, we're up a lot. So
Yeah.
S&P,
Good point.
let's say 3,800, we
Yeah.
were 3,000
Yeah.
pre-COVID. Think of, and
Good
anyone who
point.
owns a home the past couple
Oh
years,
my goodness.
your home prices have exploded.
Are they
So
going to come down during this turbo tightening?
yeah, of course, but
Substantially?
I don't know. I think it
Okay, then.
depends on the region. But
Okay. Well, I mean, it's a bubble everywhere, probably even in Kansas, but I'm on the coast. So I wanted to wrap it with this. I saw an interesting tweet by you, and you were bringing up the point that a lot of these Fed governors and officials, they're all millionaires and they own a home. And are they going to direct policy that's going to hurt their situation in the world? So, what did you mean by that?
so it's not just the Fed governors, but behind them, the staff. It's basically a small army of people who make, let's say, uh, $200,000 to $400,000 a year. They have 401ks. They're all like,
Okay,
riding the government gravy train, waiting to retire.
right.
That's just how it is. These are the people who make decisions. And it's not just the governors, but this small army of
Right.
people.
Interesting.
And they're all dreaming of, going to retirement vacations
On an island.
with their yacht.
Yes, yes.
And I have to imagine when they're sitting in a room and trying to recommend monetary policy, are they going to do something that would take that dream away? Would you do that? Let's say, well, for the good of the country, I have to tame inflation and raise the rates. But holy shit, I'm going to be so much poorer. Am I going to do that? I have to imagine there's some self-interest, a conflict of interest here
yeah,
that probably affects monetary policy. And if you think back for the past, 20 years, well, monetary policy just makes the stock market go higher. And you know who makes monetary policy? Well,
yeah,
people who will have lots of financial assets.
yeah.
I don't
Interesting.
know. So listen, no one's a saint. I have to imagine that has some impact on what they do.
Well, that's nothing compared to, were you able to trade when you were at the Fed, Joseph?
So yeah, they have constraints, but you can still have you can still have investments in the market.
Okay, well, tell me, it's not the um, most inside you could be to be, have a position at the Fed and be a trader and know what the Fed's going to do. It led to some resignations by some Fed officials. Um, if it was okay, um, why did they resign?
I think they just got pushed out just to improve the Fed's
It was
image.
just bad press,
Yeah, I think
and
so. And I imagine there isn't Fed is ultimately part of government. The people who are pushed out, they all seem to be more hawkish on the tail, so there could have been some political behind the scenes, things like that. I
okay,
mean, if you recall back then, there was a fight over the control of the Fed, whether or not it would go to Powell or someone who was more left
Brainerd,
leaning like Brainerd, right? So
yeah,
you have these factions in government who are trying to get their own people into the Fed because they understand that the Fed is very influential. And this is kind of a convenient way to get rid of a few people that maybe some particular groups, political groups, did not like.
Okay, some real sanguine talk from Joseph, and you know, you are a watchman for the community that want to know what's going on. Really appreciate, uh, you know, the mission that you have now to educate people about, you know, the house on Jekyll Island. What was the name of that book? Jekyll Island.
Yes, yes.
Yeah. Okay, and I really appreciate your time as well, and I hope you enjoyed it as well. And it was great talking to you, and I learned from you today. And
Perfect.
I'm not going to have to withdraw my cash from the bank. I don't have to worry about bail-ins now, Joseph. So the best way for people to follow you is on Twitter at FedGuy12, and then go to your website, fedguy.com. Joseph has a lot of different articles here. If you're really interested in central banking, why not read from someone who's not interviewing someone who was there, but someone who lived it. So once again, Joseph Wang, thanks for your time today.
Thanks so much, Dale. It was a pleasure being here.
Good hunting. And good hunting in our own accounts. Okay, everyone. Joseph Wang, thank you. Hope everyone enjoyed it. That's a wrap. And remember, don't just count your pips, count your blessings. See everyone next week. Thank you.